Hi everyone. Hope everyone is doing well out there. Before I do the usual and switch over to my screen share, I think one thing that I'm understanding, and certainly from my email inbox and social media feeds, etc., there's a lot of question marks going on with the overall market. Are we currently correcting? And what does a corrective phase ultimately look like? Now, what I actually want to do is share with you, I think, my client analysis that was provided a week ago. Now, what I don't want to get into is, getting into Captain Hindsight and the magical hindsight indicator that you're likely going to see from a lot of the financial gods on social media, shall we say. And what the hindsight indicator ultimately looks like is they talk through price history and say this is what you should have done. I think it's very, very important that I share with you the actual analysis called in real time so that you can see it and hopefully you get some perspective as to what a professional grade technical analysis looks like. It's not all day trading, it's not all, I think, looking for short-term counter trend moves, etc. It's about understanding the wider dynamics of the market and how we can apply that to our own investment strategies. And technical analysis is a firm place in my process and obviously our clients' process, etc. So I'm going to share with you the actual analysis that was provided a week ago because it is still incredibly relevant. It's not too late to kind of get on top of this and get some kind of game plan together. So hopefully you get some value from this, and if you do, please do give it a like, share it, subscribe, all the good stuff, and I'll hopefully pick up with you soon. Thanks. Hi everyone, hope everyone is having a good weekend so far. A thousand apologies for being so late with the analysis this weekend. For those of you that are active in the chats, you'll know that I've had issues with Optima today, so this should have been out a lot earlier than it is, but I do apologise. Now, before I get into this weekend's analysis, I think most of us understand that February was a fairly brutal month. I think most of us have given up quite a bit of gains from the start of the year. That's the game that we sign up for, unfortunately, but there's a few things that I want to talk about just with regards to the chart that you're currently looking at. Now, what I would say is I'm not saying rush for the exits. I'm not saying that there's a correction coming or anything like that. All of the data, all of the charts out there are bullish. I think that's something to highlight. There's no rush for the yen, there's no rush for gold. But that said, there are a couple of things that I look out for on a technical basis with regards to the broader market. And for those of you that are maybe new to my work, and maybe those of you that have been part of the group and my work over the last few years, you'll know that the failed breakout is a big early clue for me to say, do you know what, Sam, this is probably an environment here where I'm not going to be taking a massive amount of risk. And just to walk through what's happened in the past, we can see that with the market correction that we had in 2018, we had an overbought market. Fairly straightforward, to anticipate a market decline like that. However, what we've seen here, which was the failed breakout that you're looking at, this obviously correlated with a fairly steep drop, lots of volatility in the market. That was back in September 2018. We had a failed breakout and a decline below the 50-day simple moving average. The market crash 12 months ago. For those of you that are obviously part of the group, you'll know that as soon as this failed breakout went in, there was obviously the analysis that got most of you defensive ahead of that crash and enabled a massive outperformance over the last 12 months. But this is one of the things that I look out for. Now, we obviously had a little mini correction, I would call it. Now, quite a a substantial amount of the decline had already taken place when we dropped below the breakout level. But that said, still a failed breakout correction. That was back in September, which I should say at the time felt really bad because tech declined. I think it was 13, maybe 14%. And at the time, you know, we've seen the same fear-mongering headlines that tech has done and get out of tech, where the smart people were buying tech on that decline. And I suspect that the same will happen again. Now, the headache that I have here when I zoom in here is the 50-day simple moving average is a level in the market where if it's rising, we've got a bullish uptrend. Make no mistake about it, we're in a bullish uptrend at the moment. The last couple of days, yes, we've had a decline. We're on the 50-day again. We can get these small excursions below the 50-day. So it's not the end of the world if the 50-day is given up for a few days. It's not a big problem. But what I would say is, in an environment where you're dropping below the 50-day like that, given what we know can happen with failed breakouts, yes, buy the dip works, can work, I should say. But I think for me, if we drop below this 50-day, I will be managing risk very, very closely. For me, if we were to get a correction, and I'm not saying we are, it's a fairly logical area for something like that to take place. Now, I suspect what we've seen the last 2 days is simply just window dressing with all the fund managers, etc. A little bit of end of month rebalancing, and I suspect Monday, Tuesday we probably get a bounce higher and a resumption of the uptrend, and I think those that have bought the dip are probably going to be rewarded for that. That said, we obviously have to ask the question, what if? And what if we break below the 50-day? I don't know what it would look like. You don't know. Every market god on Twitter doesn't know. Nobody knows. That's the default answer. But what it does tell me is, Sam, time to kind of manage risk a little bit closer, tighten up stop losses, and let's see what happens. Because we know it can rebound very, very quickly if it does break below the 50-day, and that's ultimately what I would want to see. But you know, as I pointed out a second ago, it can be a precursor to a corrective phase in the market, which I have to say is healthy. It's normal. For any bull market, you have these corrections. I think on average they come in every year. So, you know, you have to expect them. Is it a bit weird, as Julie highlighted in the chat, that, you know, on the anniversary of the market crash last year, that we've got these headaches again? It's not terribly surprising. I think at this point, nothing really surprises me with the market. But yeah, I think for me, it's just a case, if it drops below the 50-day, I'll personally manage risk a bit closer. I don't know if that'll be the correct way to do it. Hindsight tells us whether it is or it isn't, but unfortunately we don't have the luxury of the hindsight indicator, and I'm sure you'll see a lot of the Captain Hindsights on Twitter posting their bearish charts after the fact. But you know, this is what I do. I obviously have to look at things in real time, and hopefully the charts make sense. The Dow has pulled back to its 50-day, as we know. Wednesday, super bullish, and then over the course of 2 days, big decline. And the question I'm asking, as I said, it's obviously the Dow and the S&P are heavily correlated. So you know, what happens if we do get a bit of selling pressure tomorrow, Tuesday? I don't know, but ultimately I do expect and hope that the market rebounds Monday, Tuesday. That's what I want to see. But if it doesn't, obviously there's question marks, and I think managing risk, and tech is the big one at the moment. I think, you know, just from my observations and the private conversations that I have with many of you about the tech stocks, what we have to understand is that the tech is obviously taking a ahead. I think it's down 6-7% already from its highs there. Everybody's calling for a correction. Technically speaking, if tech was to pull back to its former breakout level here, that would equal a 10% decline, which would give everybody the correction that they've been calling for in tech. And I think that would be a logical buy point. It wouldn't surprise me to see the triple Qs pull back here, but I think smart money buys on these dips in tech, and I don't think we need to treat it any differently. What I would say is I'm going to be going over a couple of quick charts with ratio charts, because I think there's a lot of under the surface questions that we just don't have a resolution to. But you know, the Russell 2000, we're still in an uptrend. It's still outperforming the broader market. But this is why I'm not ready to say that you know, tech is done or growth is done, like a lot of technical analysts. I think for me, very, very straightforward. This is a ratio chart of the Dow versus technology. And you know, just to keep it simple, if we're above this level in the ratio chart, then you would expect the Dow stocks to outperform technology. This is a logical level. This is kind of like the same chart that I provided a few months back with the small caps, and you know, it's a level that you would expect the small caps to start outperforming the market. And I think there's every likelihood that happens, but at the same time as well, if we break down below this, then it's back to technology. So I think there's a lot to be resolved here. Like I said, I'm not ready to throw technology under the bus quite just yet. I think it is very much open, and it's a very difficult, challenging market environment to say where the outperformance is going to come from over the short term. Going back to the value versus growth theme, again, I'm seeing many charts out there. Everybody's screaming from the rooftops that you need to buy value. Yes, it might be the correct decision. However, I think it's a little bit premature, and I think if we're below this ratio, I don't think you can say that growth is dead. I think that this is how I view it. So, you know, if we're below this level, I think you still have to be looking at growth stocks. But, you know, as soon as if price gets above this level, then I'll, you know, be the first one to communicate to everybody that value is the outperformance area of the market. That doesn't mean that growth stocks won't go up. It just means that value will be the place to be in terms of outperformance. Going back to the dollar versus the S&P 500, I've talked this chart to death over the last few months, but again, over the last couple of days, we've had a bit of a rally in the dollar index. It's correlated with the declines in the S&P and the Dow. So if the dollar's on the move, I think there's more question marks as well. So it's all something that, you know, that I'm keeping an eye on. Lots of questions about the 10-year Treasury note yield. Until this week, it was not part of my process. I have now added it to my process. Chris, I know that you were asking, is TLT a decent buy here? And I think, as we can see, I think charts make sense. And as we can see here, that there's a very clear inverse correlation. And I think one of two things might happen here, and you know, the Treasury bonds are going to move higher, and then we're going to get a decline in the yield, or the yield is going to rip higher, and we're going to get a breakdown with bonds. And obviously, the 10-year note was were the buzzwords of the week on financial media, Bloomberg, CNBC, etc. I think that there's a lot to be said, but what I do understand is that if the 10-year Treasury note yield is moving higher, then that would be an environment where you would expect the value names to do a little bit better than the growth names. That's something that I've learned this week. So we'll see what happens with that chart. Volatility was on the move a little bit, as you'd expect, but rather than, you know, walk you through the usual 15 charts for the weekend, because I've got so many question marks on where the performance is going to come from, and certainly, you know, with how brutal February has been, which I think most of us would understand is been a very, very challenging environment. I think I've got 5 names prepared this weekend, and we're just going to have to wait and see what drives the market and ultimately what happens. But I don't want to be putting out, you know, 15 charts and then all of a sudden we get market declines next week. And so I think it's very much a case of being very selective. And I've got energy names, so One Oak, I think that's how you pronounce it, above $50. Now the reason I've put this in, it's a familiar name to many of us. Certainly on this rally here, it was a stock that I was bullish on last year after the crash, and it did very well. Since then it's been building a monster base, as you can see. Really good dividend, above $50. Chevron, I think it's closed bang on $100. Now, some of you may have seen my tweet on Friday how I was saying that it looks like the rips in tech are being sold and the dips in value are being bought, and that kind of carries on with what we've seen late on Friday. The declines as the last hour went on, the selling accelerated going into the close. Again, window dressing the likely culprit there, but we'll see how things look next week. But I think Chevron, provided we're above 95, would make a lot of sense. It looks like a bit of a double bottom. Yes, we have to be aware of this level here at 103, but you know, we'll see what happens there. Caterpillar, it's a name I talked about a couple of weeks ago on this breakout. I know there's a few of you that bought it from the halftime report and is doing very, very well. Pullbacks and uptrends offer opportunity. Will it retest? Will it pull back to its roughly around its ATR? We'll see, but again, it's a name that I like a lot. We've got Las Vegas Sands plays back into the reopening theme. Hotels, airlines, etc. are all kind of moving higher at the moment, so LVS might be appealing. And we've also got Hilton, another hotel, and again, it's very easy to make the case here above, let's call it 115. So we're looking for a potential pullback opportunity, and provided this level holds, then I think you can be bullish on Hilton. But that's the weekend analysis. Again, apologies for the late nature of it. Hopefully you understand that unfortunately I don't control when laptops crash and I lose workbooks on Optima, but it's all resolved. And if anybody has any questions, thoughts or comments about this, then please do reach out, and I'll be back to answer all private questions, messages tomorrow before the open. Thanks as always.